Hi, welcome back in the lecture series by Professor Anuradha Jain. Today we are going to discuss on the topic of supply of money. Now, how do we define the supply of money? Supply of money means the currency held by the public in the economy. Now, why do we use the term public? Public here means the households and the business firms, because here we exclude the government and the banking sector just to avoid the double counting. Before 1934, Government of India was the sole authority to print currency, because in 1934 RBI Act was passed, and according to the section 22 of RBI Act, then RBI was given the sole authority and the monopoly over the note issue. So at present now all the currency of rupees 2 and above denomination is issued by RBI, and 1 rupee note and the coins are issued by the Government of India. And the money in circulation is known as the legal tender money, because it is legally accepted by all the individuals and all the authorities in the world economy of in circulation. So therefore, even a limited legal tender money and unlimited legal tender money are again two concepts related to legal tender money. The currency issued by the Reserve Bank of India, that is rupees 2 and above denominations, are known as unlimited legal tender money, and 1 rupee note and all the coins issued by the Government of India is known as the limited legal tender money. So in this session we are going to discuss about the whole concept of supply of money, what are the components of supply of money, how it affects the economy, what happens when there is changes in the supply of money, what is money multiplier, what are the determinants of money multiplier. So these are all the topics that we are going to discuss in this presentation. Money plays a very important role in the economy, and supply of money represents the monetary sector of the economy. Money supply can be defined as the amount of money which is in circulation in an economy at a given point of time. It plays a very crucial role in the determination of price level and interest rate. As we have discussed in the earlier slides, that if money supply increases, purchasing power of the public increases, and that leads to increase in the price level. And similarly, increase in money supply can also lead to decrease in the interest rate, and vice versa. Growth of money supply also helps in acceleration of economic development, because as money supply increases, purchasing power increases and demand for the commodity increases. And if demand increases, it means that business of the investor becomes profitable, and that motivates people to invest money. But there must be controlled expansion of money supply, because the excess and shortage of money supply are both harmful to the economy. So it has to be controlled and regulated in accordance with the requirement of the economy. It is for this reason that measuring money supply becomes inevitable. We all know that Central Bank of the country, the Reserve Bank of India in India, is the main source of money supply. The money supplied by the central bank is known as the high-powered money. However, the central bank is not the only source of money supply used as a medium of exchange. The second major source of money supply is the banking system in the country. And we all know that banks create money supply in the process of borrowing and lending transactions with public. So money created by commercial bank is known as credit money or the secondary money. The high-powered money and the credit money broadly constitute the most common measure of money supply or the total money stock of the country. So high-powered money, as we can see here, can be denoted as H is equal to C plus R. And demand deposits of public, that is secondary money or credit money, consist of bank money, demand deposits and time deposits. Money supply is the second most important variable in the economy after the GDP. As has already been pointed out, given the GDP and the prices, the certain quantity of money is required to carry out economic activities smoothly. So excess money supply may lead to inflation, and shortage may be the cause of deflation and economic recession in the economy. So measurement of money supply becomes all the more very important. RBI makes the estimate of annual money supply in the country and publishes it in its various publications. Now, in the context of RBI measurement of money supply, the following definition must be very important and we should keep in mind. First is that money supply is the stock variable, and measure of money supply refers to the stock of money at a point of time. By measure of money supply is meant the measure of stock of money available to the public, and the term public here means all household, firms and institution, and it does not include the producer of money like central bank, government and commercial bank, to avoid double counting. So as far as the constituents of money supply is concerned, we can divide it into two parts, like traditional approach where there was a narrow definition which was known as narrow money, which consists of like coins, currency and demand deposits, and modern approach which is named as broad money, which includes money and near money both, and also includes the time deposit. So we will discuss this measures of money supply in the next slide. There are different measures of money supply which have been used by RBI, and it has been changing time to time depending upon the recommendations of the working group. The first working group was appointed in 1961 and the second was appointed in 1977 and third in 1998. And different working groups have recommended different measures of money supply. So at present we follow the recommendations made by the third working group and currently being used by the RBI. So following are the measures of money supply which are used by RBI. First is M0, that is reserve money, which consists of currency in circulation plus bankers deposit with RBI and other deposits with RBI. Then came M1, which is narrow money, which is currency with public and demand deposits with bank and other deposits with RBI. Then M2, which is equal to M1, that is narrow money plus time liabilities of saving deposits with the bank. In M1 there were only demand deposits, but in M2 it included M1, that is demand deposits plus time deposits, time liabilities with the bank. Then M3, that is broad money, which consists of currency with public plus demand deposits with bank plus time deposits with bank and other deposits with RBI. So M3 we can say as M1 plus time deposits with banks and other deposits with bank, and also it included like post office savings also. So of the four measures of money supply, M0, M1 and M3 are the most important components of money supply measures from policy point of view. As mentioned earlier, that central bank of any country is empowered to print and mint currency, and the currency circulated by central bank is known as high powered money because it is generally backed by gold and foreign exchange reserves and its value guaranteed by the government. So the currency issued by the central bank is in fact liability of the central bank and the government. So in general, therefore, this liability must be backed by an equal value of assets consisting mainly of gold and foreign reserves or exchange reserves, especially in terms of high power foreign currencies. So in practice, however, most countries have adopted a minimum reserve system at present. In India, there are two sources of high power money, as we have discussed: the Reserve Bank of India and the central bank and the Government of India. And RBI issues all the notes of denomination of 2 and above, and RBI calls it as reserve money. The RBI issues currency of 1 rupee note and coins, including coins of smaller denomination, on behalf of the Government of India. And the currency issued by RBI has the unlimited legal tender nature, and the currency issued by the government, that is 1 rupee note, and all the coins are limited legal tender money. And the currency issued by RBI on behalf of the government account for only 7 to 8% of the total high power money. So RBI uses the following measure of high power money, that is H is equal to C plus R plus OD. That is, C is currency, R for reserves, and OD means other deposits. But since other deposits with RBI account for a very insignificant proportion of the total money supply, for practical purpose, the high powered money is measured as H is equal to C plus R, and we just ignore the other deposits. The theory of money supply deals with how this high powered money gets multiplied and how total money supply is determined in the economy. As we have discussed earlier, the total money supply that serves as a medium of exchange and store of value is supplied by two sources, that is central bank and the commercial bank. Now banks like commercial banks do not print and supply their own money. However, they create credit in the process of lending and borrowing money. In the process, the high power money gets multiplied, and the high power money multiplies itself in the process of monetary transactions between the people and the bank. And the analysis of how this money supplied by the central bank multiplies itself in the process of monetary transaction results into the theory of money supply. So basically it can be denoted as like total money supply in the economy, that is M is equal to small m into H. So small m here denotes the multiplier and H is the high powered money. So total money supply in the economy depends upon the multiplier, that how many times that money has multiplied in relation to the high powered money. The determinants of money multiplier can be grouped into two categories, that is proximate or immediate factor and ultimate factor. The immediate factor includes like currency deposit ratio, reserve deposit ratio, time deposit ratio. As far as the currency deposit ratio is concerned, the higher the currency deposit ratio, the smaller the multiplier, and vice versa. It means that if public prefers to hold high proportion of high powered money in the form of cash and a smaller proportion of its deposits, then the ability of the bank to create credit and the secondary deposit will be reduced to the extent it reduces the value of M, and consequently the M will be lower. Similarly, if we talk about reserve deposit ratio, then the higher the reserve deposit ratio, the lower will be the value of M. In simple words, if bank reserve requirement increases, like if RBI increases the CRR rate or SLR rate, their ability to create deposit and credit decreases, and therefore the value of M decreases. If we talk about time deposit ratio, then even the time deposit ratio, that is the role of ratio of time deposit to demand deposit in the determinant of the multiplier, is like that of reverse deposit ratio. It means that the higher the value of time deposit, the smaller the value of M. In simple words, like if public deposits to a larger deposits to time deposit then demand deposit, then the value of M decreases. Now if we talk about ultimate factor, then ultimate factor are the known as ultimate in the sense that they arise out of the working of the economic system and the decision taken by the central bank, the public and the commercial bank. Now the ultimate factor includes like cash reserve ratio, statutory liquidity ratio, bank rate, development level of banking sector, black money held by the public. Now as we have discussed like CRR, SLR, bank rate, if these increases, then the commercial bank are left with less money to give loan, or the loan amount goes down, and therefore the credit creation by the commercial banks goes down and M is negatively impacted. Similarly, it also depends upon the development level of banking system. Like more the bank branches are available, more people are habitual of banking system, then multiplier will increase because they frequently visit to the bank and they deposit their savings with the banks instead of holding money with them. Or black money held by the public also influence money multiplier, that is more the black money, less will be the multiplier in the economy. So these are the various factors which affects the money multiplier, and if money multiplier is affected, that means that it will affect the money supply in the economy. After discussing the whole concept of money supply, you must have understood that supply of money should be controlled in nature, because there is a direct impact on supply of money, and prices and other variables also get impacted. And there are various instruments of monetary policy and fiscal policy to control money supply, through which they control the prices and other variables. Now, if we talk about fiscal policy like budgetary policy, and you see that India's budget is always deficit in nature. Now, to finance this deficit budget, one of the instrument in the hands of the fiscal policy is printing of currency, and the other is the public borrowing, other than any other method. Now, my question is, what is the impact of public borrowing on the supply of money in the economy? So do write to me, and let us meet in the next session again. Thank you so much for your patience hearing.